Welcome to the Deep Dive, the analysis that gives you the edge. Today, we are tackling the one question that is on every single investor's mind in early 2026.
It's the big one.
It's the big one. Is the absolutely staggering supply of stablecoins, we're talking over $300 billion,
Yeah.
is that really the dry powder that's about to send Bitcoin into its next massive rally?
Well, it's the defining question of this cycle, for sure. And based on all the institutional reports and the on-chain data we've been looking at, the short answer is yes, but it's a qualified yes.
A qualified yes. So.
The correlation, between stablecoin issuance and Bitcoin's price going up is still incredibly strong. It's north of 80% over 12-month periods. But, and this is the crucial part, if you only focus on that, you miss the real story.
Which is?
The mechanism itself. The way that liquidity actually gets into the market has fundamentally completely evolved since the last cycle in 2020.
Exactly. And that's our mission for this deep dive. We want you to walk away from this understanding how Bitcoin's liquidity actually works today in this post-Genius Act world. We're going to look at the metrics that matter now, because it's not just about the number of tokens anymore.
Not at all. It's about where they are, who is holding them, and what they're actually being used for.
And before we get into the core of all that, this deep dive is brought to you today by our sponsor, Broker 360. They offer comprehensive insurance policies for all sectors: auto, home, commercial, whatever you might need. You can find their WhatsApp, their website, and their email right in the description. So a huge thank you again to Broker 360 for supporting this project.
Okay, let's start with that central idea, the dry powder. When we use that term, what did it actually mean back in, say, 2020, and how has that changed?
In 2020, the concept was, well, it was really simple, very linear.
Yeah.
Dry powder meant stablecoins, usually Tether,
Yeah.
just piling up on centralized exchanges, CEXs.
Like just waiting to be deployed. Exactly, waiting to be deployed to buy Bitcoin. The flow of money was dead simple. Fiat goes in, it becomes a stablecoin, and that stablecoin hits the Bitcoin spot market. It was mostly short-term, mostly retail speculation. It was a support floor, but a pretty basic one.
And this is where things get, exponentially more complex today. Because that simple pipe is gone. If you were to draw a diagram of it now, in 2026, the stablecoin isn't just a waypoint.
Oh.
It's the central hub of a massive financial network.
That's the perfect way to describe it. In 2026, stablecoins are completely multifaceted. They're no longer just speculative capital. They're now the primary collateral in really sophisticated derivatives markets. They're being used for cross-border payments at a volume that, some reports are saying is already rivaling networks like USA. And of course, they are the absolute foundation for yield generation in DeFi. And they've even been integrated into corporate treasuries.
So the takeaway is a huge stack of stablecoins doesn't automatically mean we're going to see a massive vertical pump tomorrow morning.
Precisely. That's the old way of thinking. What high reserves signal now is something much more mature. It signals a significant reduction in downside volatility.
It's a stronger floor.
A much stronger, more structural floor. It means there's large, strategic, and patient capital ready to absorb huge sell-offs. That's institutional behavior. And it's a safety net that just didn't exist in 2020. And to really get why this happens so fast, you have to talk about the regulatory earthquake. You have to talk about the Genius Act.
Right, the Clarity for Payment Stablecoins Act, passed in July of 2025. This was a total game changer, wasn't it? Especially for the U.S. dollar-backed market.
It ended the ambiguity overnight. This law basically institutionalized the entire space in the U.S. It imposed these incredibly strict requirements that they eliminated the headline risk.
And that was the risk that kept the big money, the pension funds, the insurers, the corporate treasuries on the sidelines for years.
That was it.
So what are the key mandates, the things that our listeners really need to remember from that act?
Okay, so there are three critical pieces. First, the 100% liquid reserve mandate. Issuers can only back their tokens with cash, insured bank deposits, or short-term U.S. Treasury bills.
So no more risky commercial paper.
Gone. That risk is off the table. Second, the law created the Permitted Payment Stablecoin Issuer License. This consolidated the market around really heavily audited players, your Circles and Paxos. And third, and this is the paradigm shift, it authorized traditional banks to issue their own stablecoins.
That's the final unlock. Because that regulatory clarity, it just removes all the fiduciary hurdles that kept that slow, sticky institutional money out of the game.
It's a classic paradox of good regulation. The sector became safer for Wall Street, which immediately unlocked a wave of capital it's far larger than anything retail could ever bring. And on top of that, there's a powerful macroeconomic alignment going on here that you just can't ignore.
You mean the fact that stablecoin growth means more demand for U.S. Treasuries?
I do. It's fascinating. If you look at issuers like Tether and Circle, collectively, they own more U.S. debt than several G20 nations. So the U.S. government now has a clear strategic incentive to support the sector's ordered growth.
They're not enemies anymore.
No, in a very real sense, they're crucial financiers of the government's own debt.
Okay, let's shift to the mechanics of how these things are created. Because there's this old myth that just won't die, that stablecoins are printed out of thin air just to pump the price of Bitcoin. We need to really debunk that.
Yeah, that's essential for anyone trying to think critically about this space. The minting process is not some guy pushing a button. It's a market-driven process, and it involves these very sophisticated players called authorized participants, or APs.
Right, firms like Cumberland or Galaxy Digital. So how does that cycle work? When a new batch of USDC gets issued, what's actually happening?
It works almost exactly like an ETF creation. An AP, let's say Cumberland, sees a surge in demand for stablecoins on an exchange. Maybe USDC is trading at $1.01.
A clear arbitrage opportunity.
A clear arbitrage. So to capture that, the AP wires real US dollars into Circle's regulated bank accounts. And only when that cash deposit is confirmed does Circle then mint the equivalent amount of new USDC tokens. The AP gets those tokens and sells them on the market to meet the demand.
So the conclusion is simple. Every new token, at least in these fiat-backed models, represents a real one-to-one capital inflow into the crypto ecosystem. It's not invented money.
It's just a conversion of old-world fiat liquidity into digital dollar liquidity. That's all it is. Which, leads us right to the academic view here. Research from the NBUR often calls stablecoins the shadow banking system of crypto.
Why shadow banking?
Because they provide instant 24/7 settlement. The traditional system, with its T+2 settlement, it takes 2 business days to finalize a transaction. Stablecoins do it in seconds. They fill a critical gap.
And we have to address the history here, the old manipulation controversy.
Of course. The ghost of that 2020 untethered paper by Griffin and Shams, they suggested Tether issuance was time to inflate prices. But I think it's fair to say that by 2026, the consensus has shifted.
What?
The evidence, the subsequent refutations, the intense regulatory scrutiny, it all points in one direction. We now understand that issuance is primarily a response to genuine market demand and a global fiat liquidity expansion. In fact, there's an 83% correlation between stablecoin supply and global M2. It follows the broader money supply.
Okay, this is the most practical part for you, the listener. How do we actually track this new, sophisticated dry powder? What are the metrics we should all be watching in January 2026?
You need metrics that measure potential. The first, and it's the one most people cite, is the SSR, the stablecoin supply ratio.
And that's just Bitcoin's total market cap divided by the total stablecoin market cap.
That's it. And the interpretation is famously, well, it's counterintuitive. A low SSR is what you want to see. It's bullish.
Because it means the supply of stablecoins is growing faster than Bitcoin's price.
Exactly. It signals a huge amount of potential buying power just sitting there relative to Bitcoin's current value. And if you look at the data from Glassnode right now, in early 26, the SSR is trending down toward its historical lower bands. It's a classic technical setup for a bull run.
Okay, so that's the big picture. What about a more tactical, short-term view of capital that's ready to move right now?
For that, you look at the exchange stablecoins ratio. This one just zeroes in on the stablecoin balances held inside CEXs like Binance or Kraken. And CryptoQuant just reported that those reserves relative to Bitcoin reserves on exchanges are at their highest level in over 6 years.
Unprecedented levels.
Truly unprecedented. It confirms the thesis perfectly. The inactive dry powder sitting in trading accounts is just waiting for an entry point.
So when we see a massive minting event like that $1 billion in USDC on Solana a few months back, should we read that as a high conviction signal from institutions?
Absolutely. A big positive net flow of stables onto an exchange or a massive public minting event is widely seen as aggressive institutional positioning. You know the saying, liquidity moves markets, narratives just move prices. This is real capital getting mobilized.
And if you're enjoying this deep dive, please take a moment to subscribe to the channel, give us a like, and let us know in the comments what you want us to cover next. You'll find 2 links in the description below. One to our fantastic sponsor, Broker360, and another to PayPal if you'd like to support the project. Even the cost of a coffee helps us keep making this content. Thank you so much for that support.
Something we have to stress, though, is that not all of this liquidity is the same. It's not homogeneous. In 2026, the market has clearly split in two, and this has some really important geopolitical implications.
You're talking about the Great Divide. Tether USDT versus Circle's USDC. What does the flow from each one tell us?
So Tether is the offshore giant. It still dominates over 70% of CEX trading volume. It's become the de facto currency in the global south across Asia, Latin America, Africa.
Right, as an inflation hedge and for payments.
Exactly, for payments outside of the traditional SWIFT network. But critically, USDT liquidity is generally more speculative, it's more reactive, and it's often tied to high leverage derivatives. It's also worth remembering Tether itself holds over 96,000 Bitcoin. They're a massive player directly.
And Circle, USDC, is the complete opposite. It's the onshore, regulated, institutional standard now, thanks to the Genius Act.
Correct. USDC is the institutional benchmark. It's what regulated entities in the US and the West prefer. Its flows are strategic, they're sticky, they signal long-term allocation by, what people call smart money. An IMF report from last year really highlighted this.
What did it say?
Basically, a surge in USDT could signal speculative appetite or maybe capital flight from an emerging market. But a surge in USDC, that signaled bullish sentiment on Wall Street, it's institutional patient allocation.
Let's talk about the new risks, because just looking at CEX reserves isn't enough anymore, is it? A lot of this liquidity is moved.
That's a crucial point. A huge and growing chunk of the total stablecoin supply has migrated to layer 2s like Arbitrum and Polygon and deep into DeFi protocols. If you're only looking at balances on Coinbase, you are seriously underestimating the total liquid capital out there.
And that capital can move much faster.
Much faster. It makes the market more efficient, but it also makes the overall liquidity much harder to track.
And this brings us to the yield factor. This has totally changed the game. Before 2024, holding stablecoins meant you were losing out on potential Bitcoin gains. That's not true anymore.
That opportunity cost has almost been eliminated. In 2026, you've got these yield-bearing stablecoins like Athena's USD offering APYs of, 10 to 20%?
Which completely changes the nature of the dry powder. It makes the capital much stickier.
Absolutely. That capital is no longer in a rush to buy Bitcoin, not unless Bitcoin's expected return is way higher than the safe, high yield they can get on their stables. It raises the investment threshold. This is what Arthur Hayes was warning about when he said we have to differentiate between real dry powder, that high-yield capital waiting for a big dip, and paper liquidity.
Which is just fragile leverage.
Fragile leverage from derivatives interest without any fresh spot deposits backing it up. Understanding that difference is, it's everything for judging true market strength right now.
Okay, let's bring it all together. As of January 2026, the dry powder thesis is very much valid, but the liquidity is just. It's more sophisticated, it's more strategic, it's more controlled. So what's the consensus outlook for the rest of this year?
The base scenarios are very optimistic. Most analysts we're seeing are projecting a Bitcoin price somewhere in the range of, say, $120,000 to $180,000 by the end of 2026.
And that's fueled mostly by this stablecoin rotation and the steady ETF inflows.
Primarily, yes.
What about a more aggressive scenario? Maybe the Fed starts cutting rates, or we get some kind of geopolitical event that triggers a flight to safety.
In that case, we could certainly see prices push past $220,000. But I think the key insight, and this comes from Grayscale's research, is that this whole institutional stablecoin integration points to a more sustained bull market with much shallower corrections than we've seen in the past.
The structural floor is just higher now.
It's much, much higher. The liquidity is patient.
It is. And that leads us to our final provocative thought for you to consider. The growth of U.S. regulated stablecoins is now structurally tied to financing the U.S. government through their treasury holdings. And it's being integrated with traditional banking because of the Genius Act. So the question is, how does this unprecedented level of institutional and governmental alignment change Bitcoin's original identity as a decentralized anti-fiat asset? Something to think about as you plan your next move. And with that, we come to the end of today's deep dive. We hope you enjoyed it, that you learned something new, and that you will join us for next one. Remember to check the description for the links to our sponsor and to PayPal if you'd like to support the show. Thank you once more.